Holy smokes, sit down for this one. 3 regional banks just quietly wrote down their commercial real estate portfolios by 40%, not 4%, 40%, and you probably didn't even hear about it. Why? Because they buried it in the footnotes of their quarterly earnings reports. They're hoping you won't notice. They're praying the problem will just go away. But it won't, because what's happening in commercial real estate right now is going to make the 2008 housing crisis look like a warm-up. And the extend and pretend game that banks have been playing for the last 3 years? It's ending. Right now. Let me paint you a picture of what's really happening. Office buildings in major cities are trading at 50 to 60% discounts from their peak values. But here's the kicker. Those buildings are still being carried on bank balance sheets at 90 to 100% of their old values. That means banks are pretending their assets are worth almost double what the market says they're actually worth. That's not accounting. That's fiction. And when reality finally catches up to fiction, the losses are going to be catastrophic. We're talking about 26 trillion in commercial real estate debt globally. In the United States alone, there's 5.7 trillion in CRE loans, and a massive wall of loan maturities is hitting in 2026 and 2027. Billions of dollars in loans coming due every single month. And most of those borrowers, they can't refinance because the buildings aren't worth what they borrowed. And interest rates are 3 times higher than when they took out the loans. This is a doom loop, and we're watching it unfold in slow motion. In this video, I'm going to show you exactly what's happening in the commercial real estate market right now. I'm going to draw precise parallels to the savings and loan crisis of the 1,980 seconds which destroyed over 1,000 financial institutions. I'll reveal which banks are most exposed. And most importantly, I'll tell you what you need to do right now to protect yourself before this bomb goes off. Because people, the fuse is already lit. The smart money sees it. The insiders are quietly exiting their positions. And when this thing blows, it's not just going to destroy real estate investors. It's going to take down banks, pension funds, insurance companies, and yes, your investment portfolio. Let's get into it. Before I show you the crisis that's unfolding right now, you need to understand how we got into this mess. Because this didn't happen overnight. This is the result of a decade of bad decisions, fueled by artificially low interest rates and a massive shift in how we work. Let me take you back to 2020 and 2021. Interest rates were at 0. The Federal Reserve was printing trillions of dollars, and commercial real estate was booming. Office buildings, shopping malls, apartment complexes, investors couldn't buy them fast enough. Private equity firms were borrowing massive amounts of money to acquire properties. Real estate investment trusts were leveraging up. Pension funds were pouring billions into commercial real estate, desperate for yield in a zero-rate world. And the banks? Oh, the banks were loving it. They were originating loans left and right. Big loans, risky loans, but who cared? Real estate always goes up, right? Here's how the typical deal worked. A private equity firm would find an office building valued at, let's say, 100 million. They'd put down 20 million of their own money and borrow 80 million from a bank. The loan would have a 10-year term at an interest rate of maybe 3 to 4%. The math worked perfectly. The building generated rental income. That income covered the loan payments, and the property was expected to appreciate in value over time. Everyone wins. Except everything in that equation was based on assumptions that have now been completely shattered. Assumption number 1, interest rates will stay low. Wrong. The Fed has raised rates from near 0 to over 5%. When that 80 million loan comes due and needs to be refinanced, the new interest rate won't be 3%. It will be 7% or 8%. That doubles or triples the monthly payment. And suddenly, the building's rental income doesn't cover the debt service anymore. Assumption number 2, office occupancy will remain stable. Wrong. The pandemic changed everything. Remote work became permanent for millions of workers. Companies realized they don't need as much office space, so they're downsizing. They're not renewing leases. They're subleasing excess space. Office vacancy rates in major cities have skyrocketed. In San Francisco, the office vacancy rate is over 30%. In New York, it's approaching 20%. Across the US, the average is nearly 20%, the highest level since the early 1990 seconds. Empty offices don't generate rent, and if you're not generating rent, you can't pay your mortgage. Assumption number 3. Property values will keep rising. Wrong. When interest rates go up and occupancy goes down, property values collapse. Office buildings that were valued at 100 million in 2021 are now selling for 50 or 60 million. Some are selling for even less. But here's where the extend and pretend game comes in. Most of those buildings haven't sold because the owners don't want to realize the loss. And the banks don't want to force a sale because if the bank forecloses and sells the building at market value, they have to recognize a massive loss on their balance sheet. So instead, they extend the loan, they modify the terms, they pretend the building is still worth 100 million, and they hope that somehow, magically, things will get better. This is exactly what happened in the savings and loan crisis, and we all know how that ended. Now let me explain the accounting tricks that banks are using to hide the true extent of their commercial real estate losses, because if you understand this, you'll realize just how bad things really are. When a bank makes a loan, it's required to assess the value of that loan periodically. If the loan is performing, meaning the borrower is making payments, and the underlying collateral, the building, is worth more than the loan amount, everything is fine. But what happens when the building loses value and falls below the loan amount? Normally, the bank would have to mark down the loan. They'd have to recognize that the asset isn't worth what they thought it was, and that creates a loss that hits their income statement and reduces their capital. But there's a loophole. If the borrower is still making payments, even if those payments are being funded by drawing down reserves or taking out additional loans, the bank can argue that the loan is performing, and if the loan is performing, they don't have to mark it down. Not yet, anyway. This is extend and pretend. The bank extends the loan maturity. They modify the terms. Maybe they reduce the interest rate temporarily. Maybe they allow interest-only payments for a period of time. Anything to avoid recognizing the loss. And right now, banks are doing this on a massive scale. Let me give you a specific example. New York Community Bancorp, a regional bank with significant exposure to commercial real estate, recently disclosed that they had extended $2.4 billion in office loans that were approaching maturity. These were loans where the borrowers couldn't refinance at current market rates. The buildings weren't worth enough to justify new loans. So what did the bank do? They extended the terms, kicked the can down the road, and avoided taking the loss. But here's the problem. This only works if conditions improve, if interest rates come down, if office occupancy recovers, if property values stabilize. What if they don't? What if interest rates stay high? What if remote work is permanent? What if property values keep falling? Then all those extended loans will eventually default. And when they default, the losses will be massive, far larger than if the banks had dealt with the problem early. This is a ticking time bomb, and the clock is running out. According to data from the Mortgage Bankers Association, over $1.5 trillion in commercial real estate loans are maturing between 2024 and 2027. That's roughly $500 billion per year, every single year, for the next 3 years. And most of those loans can't be refinanced at current interest rates and property values, which means one of 3 things will happen. 1. The borrower will inject massive amounts of new equity to pay down the loan. 2. The loan will be extended, more extend, and pretend. 3. The borrower will default, and the bank will foreclose. Option 1 is unlikely. Most borrowers don't have hundreds of millions of dollars sitting around to inject into underwater properties. Option 2 is what's happening now, but it can't go on forever. Eventually, regulators or investors will force banks to recognize reality. Option 3 is what will ultimately happen: defaults, foreclosures, forced sales, massive losses. And when that happens, banks will face a crisis. Now I'm going to take you back to the 1980 seconds, because what's happening right now with commercial real estate is almost an exact replay of the savings and loan crisis. And if history repeats or even rhymes, we're about to see hundreds of financial institutions fail. Let me set the scene. In the 1970 seconds and early 1980 seconds, savings and loan institutions, small banks that primarily made home loans, were thriving. They borrowed money from depositors at low rates and lent it out for 30-year mortgages at slightly higher rates. The spread was their profit. But then something happened. Inflation spiked. The Federal Reserve raised interest rates to fight inflation. And suddenly, the math broke. S&Ls were paying high rates to depositors, but they were still earning low rates on their old mortgages. They were losing money on every loan, and they couldn't escape because the mortgages were long-term, fixed-rate loans. So what did they do? They started taking bigger risks. They started making riskier loans. Commercial real estate loans, development loans, speculative loans, anything to generate higher returns to offset their losses on residential mortgages. And for a while, it worked. The economy was growing, real estate was booming, everything looked fine. But then the real estate market turned, property values started falling, borrowers started defaulting, and the S&Ls were left holding billions of dollars in bad loans. Between 1,986 and 1,995, over 1,000. Savings and loan institutions failed. The federal government had to step in with a massive bailout that ultimately cost taxpayers over $130 billion. Now look at today. Regional banks, the modern equivalent of S&Ls, are loaded with commercial real estate loans. According to Federal Reserve data, regional and community banks hold over $2.7 trillion in CRE loans. That's nearly half of all commercial real estate debt in the United States. And just like the S&Ls in the 1,980 seconds, these banks are facing a massive interest rate shock. They made loans at 3% interest rates. Now those loans are maturing and need to be refinanced at 7% or 8%. The math doesn't work anymore. And just like the 1,980 seconds, property values are collapsing. Office buildings are worth 40–50% less than their peak values. Retail properties are struggling with e-commerce competition. Even multifamily properties apartments are seeing stress as construction booms have created oversupply in many markets. The parallels are eerie. Let me list them out. 1,980 seconds. S&L crisis. Interest rate shock rates went from 6% to 15%. Risky lending to compensate for losses. Real estate market collapse. Extend and pretend accounting. Regulatory forbearance. Letting banks hide problems. Eventual mass failures. 2024 to 2025. CRE crisis. Interest rate shock rates went from 0% to 5%. Heavy exposure to commercial real estate, office and retail property collapse, extend and pretend accounting. Regulatory forbearance, still ongoing, mass failures. Coming? The pattern is identical. The only question is the magnitude. In the 1,980 seconds, it took years for the crisis to fully unfold. S&Ls didn't fail overnight. They struggled for years, extending loans, hiding losses, hoping for a recovery that never came, until eventually, reality caught up and they collapsed. We're in that same phase right now with commercial real estate. Banks are struggling. They're extending loans. They're hiding losses. They're hoping for a recovery. But what if it doesn't come? What if this is the new normal? Now let me show you exactly which banks are sitting on the most commercial real estate exposure. Because when the defaults start accelerating, these are the institutions that will face the most pain, and you need to know this. Because if you have deposits at these banks, if you own their stocks, if your pension fund has invested in them, you're exposed. Regional banks with heavy CRE exposure, New York Community Bancorp. This bank is the poster child for commercial real estate risk. Over 60% of their loan portfolio is in CRE. That's an insanely high concentration. They have massive exposure to New York City office buildings and multifamily properties. In early 2024, NYCB shocked the market by announcing a massive increase in loan loss provisions. Their stock crashed 40% in a single day. Why? Because the market realized they're sitting on billions in loans that are underwater, and it's not getting better. Their most recent earnings showed continued stress. Delinquencies are rising, property values are still falling. This is a bank in serious trouble. Valley National Bank, another regional with heavy CRE exposure. Over 50% of their loan book is commercial real estate. They have significant exposure to office buildings in New Jersey and New York. They've already started extending loan maturities. They're playing the extend and pretend game. But how long can they keep it up? Columbia banking system. Based in the Pacific Northwest, this bank has over $8 billion in CRE loans. They have exposure to office buildings in Seattle and Portland markets that have been particularly hard hit by remote work. Recent filings show they've increased their loan loss reserves. That's banker speak for, "We're expecting more losses," Zions Bank Corporation. This Salt Lake City-based regional has significant CRE exposure across the western United States. They have $14 billion in commercial real estate loans, and they've already reported upticks in delinquencies. Flagstar Bank, part of New York Community Bancorp now, but historically one of the most aggressive CRE lenders. They have billions in exposure to office and multifamily properties. But it's not just small regional banks. Even some of the larger institutions have concerning levels of exposure. Truist Financial, the result of a merger between BB&T and SunTrust. Truist is a major regional bank with over $70 billion in CRE loans. They have exposure across the Southeast, including markets like Atlanta and Charlotte that are seeing office vacancy spikes. Citizens Financial Group. This large regional has over $40 billion in commercial real estate exposure. They're particularly exposed to the Northeast market, where office values have cratered. US Bank. Even some of the too-big-to-fail banks have significant CRE exposure. US Bank has over $90 billion in CRE loans. That's a massive amount. And while they're larger and more diversified than regional banks, they're not immune to the crisis. Now here's what really concerns me. These banks aren't just holding these loans on their balance sheets. Many of them have packaged these loans into commercial mortgage-backed securities and sold them to investors, pension funds, insurance companies, mutual funds, foreign banks. They all own CMBS, backed by these commercial real estate loans. And when the underlying loans default, the CMBS securities lose value. Just like mortgage-backed securities lost value in 2008. It's the same playbook, the same mechanism of contagion. Alright, before I show you what the smart money is doing and what's coming next, I need you to do something critical right now. If you're watching this video and you're starting to realize just how exposed the banking system is to commercial real estate, if you're understanding that this isn't just a real estate problem, but a banking crisis waiting to happen, then you need to subscribe to this channel immediately. Because what I'm about to reveal next, the specific timeline for when this crisis will accelerate, the exact strategies that sophisticated investors are using to protect themselves, and the warning signs that will tell you when to take action. This is information the mainstream financial media will never give you in this level of detail. They want you to keep your money in the system, keep trusting the banks, keep believing that regulators have everything under control. But I'm here to show you the truth, the patterns that repeat throughout financial history, the signals that insiders are already seeing and acting on. So hit that subscribe button right now, turn on notifications, because over the next 12 to 18 months, this commercial real estate crisis is going to intensify, and you need to see every development the moment I cover it. Alright, let's continue with what the smart money is doing. Now let me show you what the sophisticated investors, the hedge funds, the family offices, the billionaires are doing right now. Because, while the mainstream media tells you everything is fine, the smart money is making very different moves. Blackstone is staying on the sidelines. Blackstone, the world's largest commercial real estate investor, has been very public about their caution. They're sitting on massive amounts of dry powder cash waiting to be deployed. But they're not buying. Why? Because they know prices haven't bottomed yet. They're waiting for the real distress to hit. They're waiting for forced sellers. They're waiting for banks to foreclose and dump properties at fire sale prices. When the most sophisticated real estate investor in the world is waiting for lower prices, you should pay attention. Hedge funds are shorting regional banks. Several prominent hedge funds have disclosed short positions in regional banks with heavy CRE exposure. They're betting that these banks will face massive losses and their stock prices will collapse. Bill Ackman, who runs Pershing Square Capital, has been very vocal about the risks in commercial real estate. He's positioned his fund accordingly. Distressed debt funds are circling. Funds that specialize in buying distressed assets at discounts are raising billions of dollars specifically to target commercial real estate. They're preparing for a wave of defaults and foreclosures. Apollo Global Management, Oaktree Capital, Brookfield Asset Management, These are some of the biggest names preparing to buy when the crisis peaks. Insurance companies are reducing CRE exposure. Life insurance companies are major holders of commercial real estate debt, but they've been quietly reducing their exposure. They're not making new CRE loans. They're letting existing loans mature without replacing them. When insurance companies, historically one of the most stable sources of CRE financing, pull back, that's a red flag. REITs are trading at massive discounts. Publicly traded REITs are trading at 30–40% discounts to their stated net asset values. Why? Because the market doesn't believe the NAV numbers. The market thinks the properties are worth less than the REITs are claiming, and the market is probably right, which means those REITs are going to have to write down their property values, which means their stock prices will fall further. Foreign investors are exiting. Chinese investors, Japanese investors, Middle Eastern sovereign wealth funds, they were all major buyers of US commercial real estate in the 2010 seconds, but they've stopped buying. In fact, they're net sellers now. When foreign capital flees a market, that's usually a sign that the local investors should be concerned too. So, let me give you my honest prediction of how this unfolds over the next 12 to 24 months. Q1–Q2 2026. The maturity wall hits. This is when things start to get really bad. Over 500 billion in CRE loans mature in 2026. Most of them can't be refinanced at current rates and values. We're going to see a wave of defaults. Office buildings will be handed back to lenders. Retail properties will go into foreclosure. Even some apartment buildings will face stress. Q3–Q4 2026. Banks start failing. As defaults accelerate, banks will be forced to recognize losses. Some regional banks won't survive. We'll see FDIC takeovers, mergers, emergency capital raises. The failures won't be as dramatic as Lehman Brothers. They'll be more like Silicon Valley Bank, quick, contained, but still destructive to depositors and shareholders. 2027. The FDIC gets involved. If enough banks fail, the FDIC will need to step in on a larger scale. They might create a resolution trust corporation-style entity, like they did in the S&L crisis, to buy up bad loans and liquidate properties. This will be a massive government intervention. Taxpayers will ultimately bear some of the costs. 2027 to 2028. Property values bottom. After the forced selling, after the panic, after the foreclosures, property values will eventually bottom. But they'll be 50–60% below their peak levels. At that point, Blackstone and the other vulture funds will swoop in and buy everything at discounted prices. They'll make fortunes over the next decade as properties gradually recover. Now, here's what I don't think will happen. I don't think this will be a 2008-style global financial crisis. Why? Because regulators learned from 2008. They'll intervene faster. They'll bail out banks more aggressively. They won't let the entire system freeze up. But that doesn't mean there won't be significant damage. Banks will fail. Investors will lose money. The economy will slow. Commercial real estate will be a disaster area for years. All right, now let me give you the specific, actionable steps you need to take to protect yourself. Step 1. Check your bank exposure. If you have deposits at a regional bank, especially one with heavy commercial real estate exposure, you need to assess your risk. If you have more than 250,000 at one bank, consider diversifying. Spread your deposits across multiple institutions to stay within FDIC insurance limits. Step 2. Avoid regional bank stocks. If you own stocks in regional banks, especially those I mentioned earlier, consider reducing or eliminating those positions. The downside risk is significant. The upside is limited. Step 3. Be very careful with REIT investments. Office REITs in particular are extremely risky right now. But even multifamily and retail REITs face challenges. If you own REITs, review your holdings carefully. Consider taking some profits or reducing exposure. Step 4. Watch the CMBS market. If you own bond funds or fixed income investments, check if they have exposure to commercial mortgage-backed securities. Some bond funds have significant CMBS holdings. Those securities could lose value as defaults increase. Step 5. Look for opportunities, but be patient. If you have cash and you're looking for investment opportunities, be patient. The real distress hasn't hit yet. Wait for the forced selling. Wait for the panic. That's when you'll find true bargains. Make a watch list of properties or REITs you'd like to own. Set target prices and wait for the market to come to you. Step 6. Consider shorting opportunities. This is more advanced, but if you understand options, consider buying put options on regional banks or office REITs, but only risk capital you can afford to lose. Timing these trades is difficult. Step 7. Stay informed and flexible. This crisis will unfold over months and years, not days. Stay informed, watch the data, be ready to adjust your strategy as conditions change. Listen, if you've made it to the end of this video, you're clearly someone who understands that the commercial real estate market is in serious trouble. You're not buying the narrative that banks have everything under control. You're paying attention to what's really happening beneath the surface, and you should be concerned. Because what I've shown you, the extend and pretend accounting, the massive loan maturities coming due, the parallels to the savings and loan crisis, this is all real. This is all documented. This is all happening right now. And over the next 12 to 24 months, it's going to get significantly worse before it gets better. But here's the thing. If you're prepared, if you understand what's coming, you don't have to be a victim of this crisis. You can protect your wealth. You can avoid the banks that will fail. You can position yourself to profit when properties hit bottom. And I'm going to help you do that every step of the way. But I can only help you if you're subscribed to this channel. So right now, I need you to hit that subscribe button, turn on notifications. Share this video with anyone you know who has money in regional banks or commercial real estate investments. Because when the next major bank announces massive CRE losses, and it will happen, you want to see my analysis immediately. You want to understand what it means for your investments, and you want to know what steps to take next. And leave a comment below. Tell me, do you have exposure to commercial real estate? Are you worried about your bank? What's your biggest concern about this crisis? I read every comment, and I want to hear from you, because we're in this together. The more people who understand what's happening, the better prepared we'll all be. Let me leave you with one final thought. The commercial real estate crisis isn't a matter of if, it's a matter of when and how bad. The fundamentals are broken. Office buildings are half empty. Interest rates are 3 times higher than when most loans were originated. Property values have collapsed, and a massive wall of loan maturities is coming. The extend and pretend game can only last so long. Eventually, reality catches up, and when it does, the losses will be enormous. But here's what gives me some comfort. We've been through this before. The savings and loan crisis destroyed over 1,000 institutions. But the economy survived. The financial system adapted, and eventually, property values recovered. This will be painful, but it won't be the end of the world. The question is, will you be on the right side of it? Will you be one of the people who saw it coming and prepared? Or will you be caught off guard when your bank fails or your real estate investments collapse? The smart money is already positioned. The insiders have already reduced their exposure. The hedge funds are already betting against regional banks. The question is, what will you do? Thanks for watching. I'll see you in the next one.